Welcome back to the Deep Dive. Today we are strapping in for a really fascinating look at the energy sector.
We are.
Specifically, we're looking at the upstream oil and gas industry. It feels like it's operating at two completely different speeds right now.
Oh, absolutely. You've got these massive international strategic moves on one hand.
And then this intense minute-by-minute efficiency push happening domestically on the other.
That tension is exactly what our sources are highlighting today. We've got a really comprehensive stack of material, which gives us a kind of 360-degree view.
Okay, so what are we looking at?
Well, on one side, we have high-level global market intelligence. These reports are detailing where the capital is flowing. We're talking billions in investment, record-breaking supply dynamics.
And the other side of that coin
is the detailed operational information. We're getting this from key industry partners, specifically a look at the services and the tech platforms being deployed on the ground. Think companies like EAG Inc.
Got it. So the mission here is to connect those two worlds.
Exactly. We don't just want to know what projects are happening. We really need to understand how companies are structurally managing these core operational challenges.
Things like data reliability, process automation.
And IT infrastructure, all the things they need to not just survive, but, actually thrive as we close out 2025 and sprint into 2026.
So the global strategic playbook meeting the local operational reality. I like it.
That's the one.
Okay, let's unpack this. Let's start with those huge strategic shifts, the ones driving billions in international investment and really reshaping the supply landscape.
And internationally, the focus is definitely leaning towards natural gas.
Take Guyana, for instance. ExxonMobil just selected McDermott International.
A huge deal.
To handle the crucial front-end engineering and design the FEED phase for a proposed offshore gas development. This project is massive.
It is, and I think the ultimate purpose of this gas is really key.
Okay.
It's slated to supply an onshore power facility. So this isn't just about export revenue for them.
It's for domestic use. It directly supports Guyana's national transition to lower-cost gas-fired electricity.
That's it. And strategically, this is the move that helps unlock the enormous, broader gas potential of the entire Stabroek block.
It's a real long-term play for stability and their own power generation. Okay, so from Guyana, let's shift to the powerhouse of South America, Brazil.
Right.
Petrobras recently received approval from IBAMA, their environmental regulator, to drill 3 exploratory wells in the Potiguar Basin. This is off the northeast coast.
And this is, it's a textbook example of balancing risk and strategic necessity.
How so?
Well, Petrobras is aggressively exploring outside of its really mature and proven pre-salt areas. They have to secure the next generation of reserves.
But the sources are clear that this area is ecologically sensitive.
Very.
So if they're drilling in a sensitive basin, isn't there a huge risk that, strict environmental conditions could delay or just halt the project entirely? That feels like a massive gamble.
It is a high-stakes gamble. But the strategic necessity is what's driving the decision. The approval they got comes with very, very strict environmental conditions.
Okay.
Which means the regulatory burden and the tech requirements for safety mitigation are going to be immense. Petrobras is basically betting that its technology can meet those hurdles.
Because the prize is just too big to ignore.
The potential reserves are simply too large. They're trying to prove they can balance development with conservation.
Meanwhile, back home, the U.S. just keeps operating as the world's major supplier. We rely heavily on data from the EIA, the Energy Information Administration, and their latest figures show U.S. crude production has hit a brand new all-time high.
Yeah, that record figure just surpassed 13.3 million barrels per day.
But
that number, it isn't just a data point. It's an insight into operational momentum.
Right, because this jump isn't from massive new drilling campaigns.
Not at all. It's almost entirely from continuous productivity gains and improved completion efficiencies, mostly flowing out of the Permian Basin.
So even with capital restraint and price volatility, the operational momentum in a place like the Permian is so powerful, it's just overriding traditional market slowdowns.
That's exactly it. And this enormous output is arriving right as winter demand starts to tighten up global balances, which just reinforces the U.S.'s role as the global swing producer.
Okay, so this is where it gets really interesting because these high domestic volumes are arriving just as we're seeing these massive focused shifts in international capital. Let's talk about the East Med region. The sums being committed there are just staggering.
Egypt is positioning itself very aggressively as the regional gas hub. President El-Sisi just met with Eni's CEO to discuss up to $8 billion in new upstream investment,
$8 billion.
all specifically targeting the Mediterranean offshore region.
$8 billion in upstream investment is a serious vote of confidence and stability. I mean, is that capital immune to regional political volatility, or is this purely about the size of the gas prize?
I think it's a calculation based on both. The gas prize is enormous, no question. But strategically, this investment is focused on accelerating exploration and, critically,
The infrastructure.
expanding the LNG export infrastructure. When you put $8 billion into infrastructure, you are making a long-term bet on stability because the world is desperate for flexible, non-Russian LNG. This cements Egypt's role in that whole supply chain.
So what's the ripple effect of that for the broader service sector if they commit to this scale of expansion?
Well, if we connect this to the bigger picture, this kind of expansion means more East Med gas influencing global LNG flows for years to come.
Right.
Service companies need to anticipate substantial demand growth across subsea, drilling, and geoscience. That means more activity and, probably some fierce competition for specialized rigs and talent in that specific region.
Okay, now let's look at the domestic market again, where supply is tightening but from a different angle. The latest EIA figures showed a pretty notable drawdown in crude inventories last week. That was paired with rising refinery utilization and, importantly, increasing export volumes.
The market signal there is crystal clear. Stronger export demand, especially when you combine it with refineries ramping up for the winter fuel season.
It's tightening the near-term supply.
Rapidly.
Yeah.
A very bullish signal for U.S. producers on short-term price strength, assuming those trends hold.
And this brings us to the biggest paradox in all the sources. Despite record U.S. production and these huge international projects, U.S. upstream M&A mergers and acquisitions activity has slowed down again.
Yeah, we're in a real M&A chill. It's driven by some commodity price softness and, crucially, widening bid-ask spreads.
Oh, okay. Explain that spread.
This is the definitive signal that companies are prioritizing cash flow and capital preservation over growth through acquisitions. The widening spread is key. Sellers still think their assets are worth last year's prices.
But the buyers are more cautious.
Exactly. Cautious buyers think prices are headed lower, so they're waiting. Private equity, in particular, is just sitting on the sidelines.
So this slowdown isn't a sign of distress, necessarily, but more like a period of disciplined caution.
Precisely. This chill, while it's frustrating for dealmakers now, could create some significant opportunities for disciplined acquirers, the companies with strong balance sheets, early next year.
Once the pricing picture clarifies.
Right. But for the rest of 2025, the focus has shifted entirely away from acquisition strategy and back to extreme efficiency strategy.
Since we can't buy growth, we have to engineer it.
Well said.
And that means fixing the foundation. This is the perfect pivot point to move from that high-level strategy to the operational support that makes all that efficiency possible. So let's look at the solutions market, maybe using a firm like EAG Inc. as our example.
Sure. EAG partners with organizations across the whole energy value chain. So mining, upstream, midstream, renewables, and all the companies that support them. Their mission, if you boil it down, is to be the partner that delivers structural, enduring efficiency improvements.
How do we know they're delivering structural fixes and not just, short-term contracts?
Well, you look at the data point the sources gave us. Over 80% of their clients rehire them after the first engagement.
Wow.
That isn't just a marketing point, it's proof. It shows that when companies are forced to prioritize cash flow and optimization, they're choosing these deep structural fixes and long-term outsourcing relationships.
That makes a lot of sense. If you have limited capital, you want certainty that the solution will actually last. So what are the main areas they focus on to achieve that?
They basically categorize their solutions into 4 areas. First is traditional consulting services for, high-level strategy. Second is IT outsourcing,
Which provides that holistic infrastructure support, critical stuff.
absolutely critical. Complex operations need flawless digital support.
And what about outsourcing the more routine functions?
That's their third area, back office outsourcing. This is where companies strategically delegate core, non-differentiating processes.
Like accounting, revenue disbursements, that kind of thing.
Exactly. Or regulatory reporting, they hand it off to subject matter experts. This frees up the E&P company to focus their own expensive internal talent solely on finding and producing hydrocarbons.
And finally, the cutting edge, new era solutions. This is where the industry is really betting on tech.
Absolutely. New Era Solutions by EAG is an AI-powered land management platform. Its entire design goal is to empower clients to do more with less. We're talking substantial cost savings and unparalleled accuracy in managing their most foundational asset.
Their land and leases.
Exactly.
So when you talk about land management and accuracy, why is that so important right now in this capital-constrained environment?
Because land data complexity is the lifeblood of the upstream sector. When capital is tight, every single dollar generated has to be accounted for precisely. Their system tackles these core business challenges by automating and optimizing processes, which fundamentally improves data reliability.
It transforms messy data into actionable information.
That's the goal. And we saw in their case studies that their ability to accelerate major software implementation is also key.
Right. The example about accelerating the Quorum TPS system for a midstream leader, it shows they can take complex foundational software and get the operational benefits realized quickly.
And that agility is non-negotiable right now. If capital is constrained and M&A is paused, companies have to maximize their existing software investments immediately. You need tech that can handle complex data fast and scale without a lot of disruption.
Which leads us perfectly to the people. If the operational engine is running this fast and the focus is on hyper-efficiency, industry professionals need to be at the absolute top of their game. Let's look at the learning paths available to them according to our sources.
Yeah, professional development is vital, especially when complexity is increasing like this. Our sources point to 3 key events, and they're all focused on maximizing the value of existing assets.
Which makes sense if M&A is quiet.
Exactly.
So let's start with the NALTA conference.
Okay, the NALTA conference, that's in Miami in early August 2025. It focuses on continuous education for national lease and title analysts.
These are the people handling the legal backbone of exploration.
That's right. They cover everything from basic to really advanced topics because the accuracy of their title work directly impacts revenue streams.
Okay, then we have the NATO A Institute in Boston.
The NATO A 2025 Institute. It's in late August, and it's dedicated to professionals in division order analysis, or DOI.
This is the person who figures out who gets paid what percentage of the revenue.
Precisely. The Institute offers leadership training, hands-on workshops on things like using Excel for the DOI build, understanding compliance, and prepping for the CDOA exam.
The Certified Division Order Analyst credential.
That's the one.
So just to be clear for anyone listening, why is mastering vision of interest analysis so critical right at this moment?
Because when assets aren't being bought or sold, they have to be managed with surgical precision. If your DOI, your revenue distribution, is incorrect, you risk litigation, overpaying royalties, or underpaying investors.
All things you can't afford when margins are thin.
Exactly. When the margin for error is shrinking, the accuracy of the division order analyst becomes a mission-critical function to protect cash flow. These skills directly support that financial discipline we were talking about.
And finally, there's a vendor-specific event in Nashville, the Inertia User Conference.
This is a perfect example of focusing on what you already own. The conference is for Inertia software customers of all experience levels. It offers updates, hands-on sessions, peer networking.
And CPE credits.
And crucially, continuing professional education credits. It's all about maximizing the value of the tools you already have, which, again, is the efficiency mandate.
So the strategic implication for the professional is clear. Upstream teams need to stay incredibly informed and agile. That means being sharp operationally through automation, through process optimization, while also staying strategically aware, monitoring global LNG projects and domestic storage data.
So if we synthesize the 2 main forces acting on the market, you see this highly accelerated long-term international gas investment.
Like the $8 billion in Egypt and the Guyana project.
Right. And that's running parallel to a highly cautious, inward-focused domestic capital market, which we see in the severe M&A slowdown. The industry is in a capital discipline phase, and that's driving this intense focus on operational efficiency.
So what does this all mean for you, the professional, trying to navigate this landscape?
The sources really point toward a pivotal moment. You have massive global capital flowing into secure gas infrastructure.
While the U.S. domestic industry is prioritizing capital efficiency and organic development for 2026, which makes that operational foundation, the consulting, the AI platforms like Era, the precise work of the DOI analysts, the true engine of value creation right now.
Efficiency truly is the new acquisition strategy.
Given that softening M&A market and the industry's determined focus on cash flow and internal development, here is the essential question for late 2025, the one that sets the stage for next year.
Okay.
How long can companies sustain record production and the required high-tech operational investment solely through organic growth before the next wave of opportunistic acquisitions begins? We are waiting to see who runs out of runway first.
Food for thought indeed.
Thank you for diving deep with us. We will catch you next time.